We are now live. Okay, cool. So we're now live. Let's just start letting people in from the waiting room and go live on IG. Give me a second. Let's just put the link out. Didn't put the link out anywhere. Hi there, Andy. Hi there, Ed. Give us a few seconds. We're going to be starting in roughly 3 minutes time. We're just going to do the disclaimer and get the
How's it going, man?
all good, all good, all good. Yourself?
Yeah, all good, man. All good.
You're good.
Got back from Singapore last week. It was a blast.
Oh, I'm jealous.
How you doing, man? You doing good? You had a good week?
Well, I was until I heard that you just got back from Singapore. The jealousy is raw, my brother. The jealousy is raw.
All good, man. It's all good.
Nah, to be fair, it's all good. It's all good. It's all good. Were you there for Token 2049?
No, like, I mean, I went for it, but I didn't actually go to the main event. I just hovered around the sides, like the side events.
This is what the real players do. You're giving out the
true.
source. You're giving out the source of how to actually get the alpha.
That's right, man. I'm telling you, man. It's all about the side events. It's all about the side events.
People don't know.
People don't know, man.
It's good to be the side dish sometimes.
It's just like it's so oversaturated in the main event. You go through so many people, zero interaction.
Yep. No quality, no nothing.
Bravo.
Yep. Same old, same old. I hear that. So I'm just posting out the link to everybody. We will be getting started in a couple of seconds. Actually, Ninja, do you want to, if I pull up the disclaimer, do you want to start the disclaimer?
Yeah.
We're doing IG live from my side or your side?
Don't mind doing it on
your
my
side.
Yeah, I'll do it on my side.
Because I'm gonna.
One second.
Just make sure your co-host.
Oh, am I back? Yeah, the internet cut off for a second, didn't it?
Yeah.
1 second. I'll go live on the IG in a moment.
Boom. So for some of you, this may be stuff you already know. For some of you, it may be a good refresher. For some of you, this may be boring. If you find it boring because it's stuff that we've gone over before, we're going to try and come at the basics from a different angle and from a different perspective. So what I would say is if you are completely new to financial literacy and you've got any questions, just stop us as we're going through and we'll answer the questions as we go along, as long as we don't get too many. I don't think we should because we're going over the super basics. And a lot of the super basics are common sense or things that you're feeling in your gut, but you've never heard anyone actualize it or put it into words, is the basics of financial literacy. So that's what we're going to do tonight, is go over the absolute basics. So I've posted that out on all the channels.
Back to basics. Basics with a twist.
Okay, cool. So let me share screen so you can do the disclaimer and we'll get started.
Join Zoom now in story. All right. What's good, people? It is currently 5 minutes past 8 p.m. UK time, Monday, the 25th of September, 2023. Welcome to another amazing episode of The Game, which is a free weekly stocks and crypto webinar every single Monday, 8 p.m. till 9:30 since 2020, soon to be on our 4th year. So to join this free weekly webinar, what you do is you go to blockchain.sensei Instagram, and then click the bio link, and then you will find the free weekly Zoom webinar. Same Zoom since 2020. It may change in the future, but for now it's the same. Before we get started with this week's episode, where we'll be going back to basics with a twist. Quick disclaimer, terms and conditions. All our content is for education, information, and entertainment purposes only, and it should not be considered as investment advice or a recommendation to buy, sell, hold any assets, nor place any trades. Please always do your own what, guys?
Research.
Yes, sir. Sorry, can you scroll down a bit? Our content is intended and should only be used for informational use only. It's very important to do your own analysis before making any investments, which should be based on your own individual circumstances. You should always take professional advice from a professional advisor or independently research and verify all and any information you may find in our show that you may wish to rely upon, whether you wish to make an investment decision or otherwise. Mr. Harding, Jeremiah Johnson, Martin, Ed, Andy, anyone else in the IG Live or YouTube Live, or any of you guys, professional financial advisors?
I'd say Martin looks like one with his shave.
Nope. And even though Martin may look like a professional financial advisor, I don't believe, to our knowledge, he has any accreditations. So again, you should always take independent professional advice from a professional advisor. Alternatively, research and verify all and any information you may find in our show that you may wish to rely upon, whether you wish to make an investment decision or otherwise. All investments come with what, guys? If you don't mind scrolling down. All investments do not come with rewards. That's trolling. All investments come with a risk, so please always do your own research. Now, myself, Mr. Harding, Jeremiah Johnson, Ed, who else we got in there? Martin, Andy, and anyone on YouTube Live, to our knowledge, are financial advisors or professional financial accountants. However, we work in collaboration with several accredited advisors and also several accredited crypto specialist accountants. If you're unable to mitigate your risk, let us know by tweeting us at blockchain, DMing us at blockchain.sensei, emailing us at hello@blockchainsensei.com saying, I need a financial advisor or crypto accountant, and we'll put you in touch with one as soon as possible. So
I'm going to show them something
Mr.
behind the
Harding, we're going back
scenes.
to basics today, but with a twist.
Yep. So I'm going to show them something behind the scenes, real behind the scenes, something that's coming in the pipeline. So here's a little sneak preview.
Hey everyone, welcome. I'm Emmanuel Super, financial advisor, and welcome to the BCS Academy course.
Wait. Did people hear that? I don't know if you can hear it.
Hey everyone, welcome. I'm Emmanuel Super, financial advisor, and welcome to the BCS Academy course. I know you're going to learn a lot. I know it's going to be fun, interactive, and you're going to be surprised at how great you're going to become. But the first thing you need to do is book a call with me. So click the link below and enjoy lesson 1. Speak to you soon.
Bam. So that is Emmanuel Asuko, actual accredited financial advisor that we're working with on our financial literacy course. And what we're going to give you here today is the first part that we give to absolutely anybody for free. This content that we give to anyone is completely for free. So if you know anyone that's interested in investing in stocks, crypto, whatever, or just wants to learn about money, give them a link to this episode. We will put them in contact with a financial advisor, Emmanuel Asuko, and then we can start teaching them. So let's get into it. So the first thing we're going to do is we're going to load up this little booklet. So this is called the BCS Academy Financial Handbook. Now, why is it called the BCS? Because that is our little name for our academy, BCS, Blockchain Sensei. We just felt BCS will help people, as a lot of people think that we only do crypto, but we don't just do crypto, we do financial literacy in general. So this is a guide to mastering your finances. So we're going to go over the introduction to the basics, the big picture, where's the money, where wealth, keep their money, the impact of the dollar and asset classes, property pros and cons, and then the compound interest calculator, everybody's favorite. So ultimately, don't worry, it's better that you know nothing than for you to think you know something. That is the ultimate golden rule of financial literacy and your entire financial journey. You want to always be challenging yourself. You want to always be finding a group of community that is going to challenge your investing ideas. You want to go to them with an idea and go, I think Bitcoin's the greatest investment. And you want a group of people that are going to challenge that and go, no, I think this, I think that. Case in point, I used to be very anti-Solana. It was only because of the group that brought me around and educated me on things and gave me perspectives that I didn't have that made me go, actually, you know what? I changed my mind. You've given me enough different angles and perspectives. This is a great investment. And now I'm a big Solana investor. So you are not alone. And ultimately, it's better to start now than to start later. When we get to the last bit, which is the compound calculator, please stay to the end for the compound calculator. If you've never seen the compound calculator, please stay to the end for that. It's better to start now than later, and you will see why. And it's also better to start small than to not start at all. So let's look into some stats. And these stats are from none other than BlackRock. So if you don't know who BlackRock are, we're going to get into that later on. So wealth isn't just for the wealthy. In the UK, money is the #1 cause of stress. So as we know, stress is related to things like cancer, like heart disease. Most of the NHS is full because of people doing things to avoid stress, like drinking alcohol, like smoking, so on and so forth. So when people begin investing, they see immediate emotional benefits compared to non-investors. Investors are 16 percentage points happier, 23% more points about their well-being, and 20 percentage points more fulfilled. Why is that? That's because you've got an asset and you've got something that you control, well, that you own, that increases in value if you're selecting the right assets. Meaning that whatever you're doing, you know that there is another thing that you have going for you. It's like having insurance. So out of everyone that's in the call, type yes in chat if you feel more happier and more positive about your well-being and that your mental health is in a better state since you started investing. That's one yes. Just one yes in the chat so far. Obviously, if you've been investing in only meme coins, then I don't expect your mental health to be any better. But yeah, Crypto Boss, yes. Jeremiah, yes. Debem, yes. So there we go. The audience has said yes. So only 37% of Brits have ever made market-based investments. And the reasons people say they don't invest is because of lack of resources. They don't think they've got enough money. But how much, let's see if anybody in the audience knows, how much money do you need to start investing? What's the minimum investment you can make on Revolut, Free Trade, on Coinbase, Swissborg, Crypto.com, most of these platforms? Does anyone know? £5 we've got as an answer. £10 we've got as an answer. The actual answer is £1. £1 is all you need to start investing. Does everybody in the UK have possible access to £1? Now, because we're Blockchain Sensei, if you don't have £1 and you can prove it to us that you have not got £1, when we deliver this lesson to you, we will give you some pounds to make your first investment. This is how amazing, how confident we are in what we're doing. If we know that you haven't got any money, we will give you the financial literacy, help you make an additional income from side hustles and side jobs, and even show you ways of generating income for free. Because guess what you can do on some platforms? You can go and educate yourself and get free money. So Coinbase is one of those platforms which we'll talk about in another episode, where you literally do learn and you can get paid £5. I think at the moment it's up to a total of £35 just for doing some education. Simple. So 34% of people think they don't invest because of fear of failure. Now, this is the scariest fact. All of these factors culminate in insufficient investing. In fact, 50% of the 26 trillion European wealth market is currently in uninvested cash, earning zero interest. So that is,
mind you, this is August 2018, so
It's
it's
way higher now.
more now, way higher. Maybe almost double. I don't know what the exact stat is, but I'd assume at least 40 trillion now.
yeah, I would say at least 20 trillion is just sat there in cash, doing absolutely nothing. So what's the current solution? Only 6% of people in the UK have ever consulted a financial advisor. In the last 12 months, this is in 2018, 3% of people had received financial advice, 97% had none. So out of the whole of the UK, only 2.6 million people had financial advice, and it meant that there was, well, that's how many financial advisors there is. There's 26,700 financial advisors. They can each take on roughly about 100 clients each. So that would only serve 2 million people. That would mean 51 million people in the UK would go without financial advice. So what are we going to talk about? We're going to talk about other ways of progressing and getting your financial literacy skills up. So let's do that right now. So I hope everybody's found some of those facts useful or interesting. Did you?
It's a nice refresher. I forgot about them facts because I feel like sometimes when you live in the world of investors and traders, you forget that most of the world don't do so.
Yeah. So let's
this-
go to the absolute basics. Type in chat if you know what this is. Does anyone know what this is? Let's see if anyone's answered.
I'll give you guys a clue. Robert Kiyosaki.
Anyone know? Okay.
The
So
cash flow quadrant.
yes,
Yes,
that
sir.
is indeed the cash flow quadrant. So the cash flow quadrant was created by Robert Kiyosaki, and it's a great way of explaining how life works. And again, like I said, some of this stuff is really simple, but no one's ever explained it to you this way. In life, we have 4 different categories that we can fall into. All right. And in these 4 different categories, these decide our financial outcome. So the left side is where people exchange their time for money. The right side is where they exchange money to make more money. So let's see. The employee, what they do is they exchange their time for money. It means that whatever they're getting paid per hour, times that by 40 hours a week, times that by the 52 weeks in a year, that is the most amount of money they can ever make, apart from bonuses and commissions. And on top of that, they only get paid most of the time 12 times in a year. And on top of that, they normally only get 30 days of holiday. Okay. Now, underneath is you have self-employed. Now, these guys have got a little bit more control, but not necessarily more time freedom, not necessarily more money than those that are employed. They just have more control over when they're going to work and when they're going to take holiday. However, most of the time it means, and this is jobs like an electrician, a plumber, a doctor, stuff like that. Now, the problem with this area here is it's dependent on you. So if you are injured, if you are sick, you can't make any money. So that's the problem with this area. Now, the next area is the business owner. So what a business owner does is finds a problem in society and offers a solution for it, either by acquiring stock, or creating a service, or creating a digital product or service. As simple as that. We all know what a business is. We've all seen a business before. So they exchange money to make more money. They invest into product, services, whatever it is, and then sell those with a margin or a profit margin to other people. Now, what does an investor do? They take their money and they invest it in the business owner. The business owner then employs people. So all the employees' work goes back to the business owner, and the business owner's work then goes to the investor. So the person that gets the most time freedom is the investor. The person that has the most control and power and influence is the investor. Every single one of the corporations in the FTSE 100, in the S&P 500, guess who they have to answer back to? Their investors, not their customers. So here, when you click the hand, is a little video taking you to the cash flow quadrant. If you wanted to go over that again in more detail in your own time. So let's go to the next bit. So this, Ninja, do you want to cover this one or should I do it?
Yeah, so this is a basic way to do basically accounting, self-accounting. So on one side is your income. Now, most people only have one or two income streams, where the average millionaire has at least seven, which is why one thing we advocate at Blockchain Sensei is multiple streams of income. And the great thing about having investments is, let's say you invest in dividend-paying yield stocks. They give you a yield, which is a form of income, or you can stake your crypto, and that's a form of income as well. And then on the other side is expenses, which is basically everything that you spend money on. Every minus in your bank account is an expense. Then we've got assets, which is anything that increases in value over time and or generates income. And then on the other side, we've got liabilities, which a lot of you guys will know, is just anything that takes money away from you and doesn't add to your balance sheet. So this is something that very few people actually do when it comes to self-accounting, and it kind of what divides the rich and the poor.
Cool, perfect.
So let's go through the starter pack.
So in the what we've got is links to the audio books and PDFs to the start of your journey. So there's a link to a mini video explaining Rich Dad Poor Dad, a mini video of the cash flow quadrant, and then the full audio book, and then the full audio book of cash flow quadrant and Rich Dad Poor Dad, and then the full PDFs, and then a link to an income and expenditure sheet as well that you need if you want to be successful financially, managing your own personal finances. So this is where what the poor do is they have one income stream and then they only have expenses. Middle class, what they do is they have one income and then they have expenses, and they mainly have loads of liabilities like mortgages, car loans, and so on and so forth that they think are assets. But the majority of the time, those assets aren't paying them. Say, for example, a house, they will have a house, but that house isn't paying them any money because they're not renting out a room or renting anything out from it. So therefore, it's not an asset, and the bank owns it, and they're paying interest on it. So the rich, what they do is they have assets. They have assets such as real estate, property. We just mentioned that. They'll have stocks. They'll have bonds. They'll have convertible notes. They'll maybe even have some IP if they own certain businesses. And these pay them incomes like rental income, dividend, interest, and royalties. And then their expenses are tax, mortgage payments. And that's it. So hopefully that's made sense to people. You can get access to this starter pack. In fact, let me just put the link to the starter pack in the chat. Everybody that wants it. There we go. Okay. So then what we have is we have also in the starter pack is this, which is an exact copy of what my personal financial statement sheet looks like. So this is what I fill in every single month, which is my asset value, my money that I get from a job that I'm working, my own income, so money that I make from my own business, that being Blockchain Sensei, asset value that I have, own income profit, because obviously if you're running your own business, then there's going to be expenses, so you only want to include the actual profit. Then I have the debt that I have, the total outgoing. So the total outgoing is an addition of all of this. So MISC is just money I've spent on random things. So I include clothes in this. I include eating out with friends in this. I include just buying a PlayStation game, basically treating myself, and miscellaneous stuff goes in MISC. Travel, pretty obvious. Accommodation, pretty obvious. Food, pretty obvious. Bills, pretty obvious. Interest payments and debt paid. Add that all up. and then that goes to total outgoing, and I assess and monitor that every single month. So just gotta mute them. So then if you are in a couple, you want to have this as a couple, because if you're in a couple and you're not looking at your finances together, it's going to be very difficult. And it's a lot easier if you put all of your money together and work together and grow a family estate. Then I put a category for new investments. This includes inventory. So say, for example, if it's product that I'm buying to then sell on, whether it's trainers, whether it's comic books, whether it's dog leads so that I can become a dog walker, that's in your inventory section. And education, because the most important area you should be investing in first is your education. Then, because most people, what they do is they finish school at 16 or 18 or university at 21. And then for the rest of their lives, 60 years, they don't educate themselves and wonder why they're not moving forward in life. So if the world is changing, but you're not changing, you can expect the world to change against you. So then I put stocks, crypto, cash, and the total net worth on the end. So that's what I track every single month. This is also in the starter pack. I'll copy this and put it in the chat. Everybody should have one of these. And this is financial literacy 101 of things that they definitely haven't taught anybody in school. But if they did, oh wow, things would be very different for a lot. Just by having that, things would be different. Okay, so inflation. I'll touch on inflation, Ninja, and then you can do your favorite one. So, inflation and shrinkflation. So a lot of people have heard of inflation, but a lot of people haven't heard of shrinkflation. Shrinkflation and inflation combined are why life gets difficult. So what happens for most people is we work really hard and we get the one job, and we probably get promotions and probably get raises, but it's very rare people get a raise of above 5%. And it's very rare that they get a 5% raise every single year. But what is not very rare is inflation. That happens every single year. The average inflation rate is around 2%. So we can see if after 10 years, your wage hasn't gone up, but inflation has gone up by 2%, that's everything in life now costs 20% more. So here is an example. Does anybody recognize this chocolate bar in the corner? Probably do. His name is Fredo. He's a good example and a good way of calculating inflation, because at one point you could have got him for 5p. Sorry, my nose is itching and my nose is running. So sorry, guys. I'll try and fight through. So yeah, you could have got a Fredo bar for 30p. Several years later, this Fredo bar will cost 37p. Same thing with a coffee at Starbucks. You probably would have noticed was £3. It's now probably around £3.50, £3.60. A train ticket would have cost you £30 from somewhere to somewhere, and now it costs you £36. Your rent would have cost you £300, but now it's costing you £365. A car would have cost you 30 grand for a Merc, but now it's costing you around 36 grand. A house would have cost you 300 grand, but now it's costing you 365 grand. So as you can see, inflation goes up. However, last year, inflation got a little bit crazy. So it wasn't even just the 2% it increased by 10%. So that meant that this Fredo bar, and it doesn't damage you that much on the smaller items, but on the bigger items, it definitely does. So what the problem is that is shops buy things in bulk. So let's say, for example, you're a boss man and you're buying the Fredos. You're not buying them for the 10p that you're selling them for. You're buying 100 of them at 10p each. So if the price has gone up, right? If you were paying £100, you're now paying £110. So now you got to pass that cost on to your customers. So you got to charge them a little bit more because you got to make more profit. So we can see inflation around the world was a bit crazy. 10.7 in the UK, 9.1 in the USA, and 85% in Turkey, and 88% in Argentina. So could they have done with some financial literacy help over there?
Can I just add with regards to Argentina? I watched this on a YouTube on the Economist YouTube channel. Inflation in Argentina is so bad right now that a lot of shop owners have to adjust the price of milk and bread multiple times a day, like sometimes up to 3 times on the same day. That's how bad inflation is in Argentina.
That's actually crazy. In the same day. That is mad. Crazy. Okay, cool. So let's say you inherited or saved 300 grand and you plan to buy a house. Well, 10 years later, that 300 grand is now worth 65 grand less if inflation stayed at 2% per year. So what this basically means is if you have money, especially the larger amount of money you have, you can't let it just sit there because it erodes, it decays. So let's go on to understanding what shrinkflation is. Shrinkflation is the reason life seems like it's getting harder. Life is getting harder every single year because, number one, inflation, the price of things are going up. But number two, the quality of products and the size of products actually goes down. It's not you thinking it, it's actual fact. So that means you're paying more money, but you're getting less back. And then cuts start happening on services. So say, for example, there'll be less tubes on the tube, or there'll be less rice in your rice that you bought, or there'll be less biscuits in the pack of biscuits that you bought, or they'll change the quality and there's less sugar in it, or whatever will happen. Type yes in chat if you've noticed that. Yep. So that is what is called shrinkflation. So the only way to combat that is to grow your wealth. So Ninja, over to you. Let me just unmute you.
Okay, so in one big step that separates people from financial illiteracy and financial literacy is being able to quickly identify millions versus billions versus trillions. Anyone who is unfamiliar with billions and trillions, I want you to remove the scare factor, because it sounds scary, billions, trillions, but once you normalize these numbers in your head, it allows you to be able to read big numbers and understand more what's going on in the world. So, as we know, all a million is okay, it's not actually written here. In fact, can you just make me host? Because there's actually it's not written down here. We actually should edit this. Oh, I'm already host. Okay, amazing. Let me just make sure and just remove this 1 second. Okay, new window. Ready to share my screen. Okay, I'm going to share an empty notepad right here. Right, fantastic. So, a million, right, as we know, is 1 and 6 zeros. So that's 1 mil. Now, whether it's 1 mil or 100 mil, what do we notice? The cheat code to know if something's in the millions is the fact that there's 2 commas in it. 1, 2 commas. 1, 2 commas. It doesn't matter if it's 1 million or it's 999,900,099. It's still 2 commas. Okay, just iterate that. Now billions. All a billion is, so 1 billion. So I'm typing with one hand here because I'm streaming on IG on the other hand. 1 billion is just 1,000 million. So that's 1, 1,000. Everybody knows what 1,000 looks like. And then you add your 6 more zeros, comma, 1,000 million. Now, how do we know something's in the billions? Is it's got 3 commas. So it doesn't matter if it's 1 billion, whether it's 100, whether it's 100 billion, or whether it's 999,999,999,999. It's still 1, 2, 3 billions. Sorry, three commas. Okay, and then finally, trillions. The number of the elites, the size of entire market caps of asset classes, whether it's oil, gold, or when you're talking about Saudi wealth, you're talking about trillions. We're talking about BlackRock, Vanguard, these asset management companies, they manage trillions. Okay, so let's normalize what a trillion is. All a trillion is 1,000 billion or 1,000,000,000. Let's write 1 trillion down. 1, 0, 0. That's 1,000. 0, 0, 0. That's 1,000,000. 0, 0, 0. That's 1,000,000,000. And then, 3 more zeros. So, what identifies a billion? 4 commas. Whether it's 1 trillion, and I'm going to come up with a number which is pretty much larger than all the financial markets put together. Whether it's 1 trillion or 999 trillion, 999 billion, 999 million, 999,999. What have we got? 1, 2, 3, 4 commas. And although this here, if you can break this barrier and simplify millions, billions, and trillions, it will open up keys to wealth and numerical understanding that until you get to the place where you're comfortable with millions, billions, and trillions, and hopefully this broke it down and brought you closer towards there, especially if you're not a numbers person, it can definitely change your life.
Yeah, you need it
over to Mr.
measure
Harden. That's
market cap.
millions, billions, and trillions.
So it's essential to be able to do that so that you can look at market caps of companies and compare them, which we're going to get into in a second. So what we have to understand is with a trillion, if you have 1 trillion of assets under management, you are only trying to make 1%, 2%, 10% gain, because that's a lot of money, as we can see here. Because 10% of 1 trillion is still 100 billion. 1% of this 1 trillion is still 10 billion. Make sense? So this is why they don't need to make a lot of money to make a lot of money. If that makes sense. So let's look at the big boys. So this is probably one of the most important things you can learn on your journey, is understanding who the big boys are and why the markets move. There's a lot of fugazi that people are taught about why the markets move. The markets move because of a thing called liquidity. What does liquidity mean? Liquidity means things being taken out of assets and being turned into cash, or things being taken, cash being turned into assets. Because there isn't actually even 9 trillion of cash floating around. There isn't that many dollars in existence. But what there is assets. So what these companies do is they manage people's assets. Whose assets do they manage? They manage mainly pension funds, mainly insurance companies. Why? Because they have a lot of cash that, as we've seen, sitting on that cash, it does nothing. Now, why do they need to manage pension fund money? Because if your pension isn't moving and beating inflation, then your pension is basically pointless. And this is where a lot of people go wrong, is their money is invested in pension companies that aren't beating the market and aren't beating inflation. So then when they come to retire, they're still struggling. So BlackRock have 9 trillion of assets under management. Vanguard, 7.6 trillion. Fidelity Investments, 4.2 trillion. Morgan Stanley, 3.1. JP Morgan, Goldman Sachs, Alliance Group, Bank of New York Mellon, UBS, Deutsche Bank, Legal & General, Bank of America. So
Wait. Let's break down why it's trillions. So if you scroll up, let's break down the language of finance for a second. So as we can see here, this word here, AUM, that means assets under management. And then this here is US dollars, but it's US dollars in billions. What did I say a trillion is? It's 1,000 billion. So 9,090 AUM means 9,090 billion, which is 9 trillion. Sorry, over to you. I think that was an important
No,
point.
no, that's
'Cause a
important.
lot of people might not understand.
That's important. So one of the things you'll learn about wealth is they're always trying to hide how much money they actually have. The wealthiest people you will ever meet will not be wearing head to toe Gucci and have a shiny bust down Rolex. It's just not what billionaires do. Because once you get into that category, it's about making as much more money and not trying to let people know what you've got. You just won't see it. So this is why it's classed as trillions, not as billion, and it's written like this here, US billions rather than trillions. So
To confuse you.
one of the things we want to notice is where is the UK in this ranking, and how much potential liquidity do these American asset management companies have? As we can see, there's a lot. There's a few trillion.
Yeah, that is about 30 trillion.
Yeah.
6 companies.
The first time we see the UK is all the way down here at number 18 at 1.4 trillion. BlackRock have lost 1.4 trillion in a year and it didn't affect them. Let's just keep that in mind. So where do we want to be investing? With the small fries or with the big boys? That's the first bit. So let's now go and look at companies. Hopefully this is updated, because last time I did it, it keeps doing this. It keeps glitching and saying Bank of America is number 1. Don't know why, but it is. Anyway, so companies via market cap. So as we can see, Apple is number 1 with 2.6 trillion market cap. What does that mean? That means all the assets, all the inventory, everything that Apple owns, all the stocks, all the IP, everything is worth 2.6 trillion. Microsoft, 2.1 trillion. Now, Google are very sneaky. What they do is they split it into two, 1.3 trillion and 1.3 trillion. Why do they do that? It's because there's 2 types of shares for Google. There's Alphabet and then there's Google. And what they do, one of them gives you voting rights as an investor and one of them doesn't. And then there's I don't know why it's showing it like this. So there's a few errors on this website. So please forgive us on that. So before we go on to the next bit, there's a very, very important bit that we need to show.
Oh, somebody's asked a very important question. MG says, is there a link to the table of asset managers? Instead of sending you a link, let's show them how easy it is to get to that link. All you do is you go to Google and you type in top asset management companies.
And it'll come up. It's the second one.
What
we're gonna do is we're gonna give people this. We're gonna give people the link to this anyway.
Okay.
So something that we need to understand, right? So we just spoke about the Vanguard, right? So this is just one of the portfolios that they have. Just one. All right. Let's just make sure it's the right one. I always do this wrong. VT and VTI. Let's just make sure. Yeah. Okay, cool. So this is just one of the Vanguard portfolios and one of the products. Its value of assets is 1.4 trillion. So if this index goes down by 10%, which for it to go down by 10%, what does that mean people have done? Sold. So if 10% comes off 1.4 trillion, how much is that? Someone type in chat, how much extra liquidity is that in the markets? Is this finance people don't talk about? 140 billion. You wasn't meant to answer that, Ninja. But but yeah, that would be 140 billion that has been taken in profit. The reason the markets go down is because somebody has taken profit. So that's 140 billion now in cash somewhere. It has to go somewhere, because keeping it in cash does what? Nothing. So let's go and understand a little bit more about how this portfolio of 1.4 trillion of assets is set up. So we can see the different sectors that this is being held in. So we can see that energy makes up 4% of that 1.4 trillion. and tech makes up 30% of that 1.4 trillion. So if the Vanguard goes down by 10%, it's actually affecting 3% of the technology stocks. And then we can look even more detailed and we can see which companies they're holding directly. So Apple is 6%. So for hypothetical reasons, we're going to say that Apple was 10%, right? And if Vanguard goes down, Vanguard was this one that we're looking at was worth 1 trillion. So if it goes down by 1 trillion, that's 100 billion that's been taken off Vanguard and is now cash. But that would also mean if this was 1% in Apple, that would then also mean that because Apple's market cap is 2.2 trillion in this example, that'd be 10% off them. So that's 20 billion. So we're noticing how it's all tied in together. Hopefully that's made sense the way that I've explained it and I've explained it correctly. Fingers crossed out. Cool. So let's move on and move back. So where is the money? So this is a very important lesson to understand why the rich stay rich and the poor get poorer. It's because we all store money in different places in different ways. What we'll see is those with a net worth below 10K, the majority of their net worth comes from the house that they live in, not the house that they own. Note that I've said that they don't own it, because if they owned it, the net worth would be higher than 10K. Make sense? So the next largest part of their wealth is made up by cars and vehicles they own. So most people that are rich but not wealthy will have 2 or 3 cars outside their house, but they won't own the house. And they won't have that much they won't have hardly anything in stocks. They'll have hardly any business interest. They'll just be working a job, which they can get fired from at any point, which will then make it difficult to pay the mortgage off and so on and so forth. And you can see they have a fair amount of liquid cash and not that much life insurance. Then when we get down to the 100K mark, we can see again, it increases in terms of the primary residence. Why? Because they've paid off a little bit more of the house and now they could get a little bit of refinancing against that bit of their mortgage. They're less interested in looking rich now because they've got the 100K. And then when we get to the million mark, we can see they really don't care about how they look because they know they're a millionaire. But what you would have seen is that now their business interests have increased. And now also we can see that their stocks have increased. Because once you're a millionaire, you're exposed to other millionaires and you're going to be exposed to what they're doing. So you're going to be interested in how they've made money. And a lot of them would have made money from investing in businesses, owning businesses, and investing, as we saw from the cash flow quadrant. But what we have to note is by the time you get down to the 100 million and 1 billion mark, we can see that the amount of cash that they're holding goes down and the amount of equity they own in businesses goes up. So the reason Elon Musk is a billionaire is because the amount of equity he owns in Tesla and then the market cap of Tesla. That's the way that it works. So people can become billionaires and multimillionaires, get into this 100 mil category by having a job. But if that job is paying them in equity rather than just the salary. So if you're on a director in a company or an MD, most of that time, if you're an MD, managing director, it means you're getting paid in equity. That is the key difference between any other position in a company. Director normally means you're getting paid in equity. If you're not getting paid in equity, that means when that company gets sold, you get nothing. That means when that company goes public, you get nothing because you're not a director. You aren't getting any equity in the company. So always do what you can to negotiate getting yourself some equity. Cool. So the impact of the dollar and different asset classes. So the dollar is the most important currency in the world. Why? Because everyone uses it as the reserve currency. So in Jamaica, in India, in wherever, they will be doing buying and selling with other countries, their imports and exports with the dollar. So if the dollar goes up in price, what happens to the world's imports and exports? They get more expensive. So therefore, they have to pass that price on to the consumer. What happened last year? the price of the dollar went up. That's why the world is in the position that it's in. And then it then means that wages get more expensive, materials get more expensive. Does that make sense? Hopefully that makes sense to people. So let's have a look at this. So this is all the world's money visualized. So this is the amount of silver, 43.9 billion. This is the amount of cryptocurrency, which is way higher now. This is military spending. This is the coins and banknotes. This is actually how much money there is in the world, 6.6 trillion in physical cash. This is the amount of billionaires. There's 2,095 billionaires that own 8 trillion amongst them. This is gold. There is about 10.9 trillion worth of gold.
This is slightly outdated, by the way, because I know gold's like 13 trillion now. But
Yep.
yeah, this is this is basically
COVID,
May
yeah.
2020, so the start of coronavirus.
So this is the Fortune 500, the top 500 companies, but we can see that the S&P 500 is weighted quite badly because the top 5 make up 24%. That was then. They made up 24% of the S&P 500. This is the total stock markets. So the total value of the entire stock market is 89.5 trillion. 31% of that is made up by the New York Stock Exchange. 14% of it is made up by the Nasdaq. And somewhere down here, somewhere is the London Stock Exchange. We make up 3.5% of it. So world's money supply, as you can see here, global debt, global real estate, global wealth.
Notice how the world has more debt than money. That's the funny thing.
Yep. One man's debt is another man's assets, because the only asset that isn't debt-based is gold. There's no debt involved in it. And technically Bitcoin. But yeah, we'll get into that in a more advanced lesson. That one. So that's the value of the dollar. Hopefully this is all making sense. So the common myth about commodities. Most working class families, what they do is they acquire the first asset that they acquire outside of their job is gold. Most people are given gold on their 16th birthday, 5th birthday, 1st birthday as a present, as an investment. Let's go and look a bit of financial literacy at the performance of gold, because this is the thing that people don't do. Now, if you're in Indonesia, it might be a bit different. But if you're in the UK,
This is gold against the dollar.
yeah, we can see gold hasn't really gone anywhere, especially since if you bought it in 2020 at the high, or if you bought it here in 2011, you've not really made that much money. Maybe if you bought it in 2000 to 2008, cool, you made a bit, but in comparison to what you would have made from the stock market, not even comparable. So let's just show you. So let's just say it was just the S&P 500, right? In the same time frame. See? Over the last 10 years, substantially different. Let's say it was in comparison to just one stock. We'll go with Apple. If you were given Apple stock versus gold as a present for a child, there is a 3,400% difference. So again, financial literacy that just isn't shared. The wealthiest of the wealthiest, what they do when they have a child is they create an investment ISA for them straight away. So that what's happening is they're investing tax-free for them, and then when they're 18, they unlock it and give it to them. The child's automatically a millionaire. Whereas what we're doing in working class, middle class backgrounds is doing not that. Cool. So that's a horrific fact that we need to share with people. Sorry if that made anyone uncomfortable, but it's an uncomfortable truth. So that's commodities. Then we have real estate, bonds, debt, stocks, and cash. And we're going to look at the returns of these different asset classes in 2023 and how they've performed over the last 10 years. So here's the stats. So stocks, as of May 31st this year, did 9%. last 10 years, 11% on average per year. Then we've got bonds, 2.6%, 3% on average every year. Cash, 0.9, because obviously this year the value of cash, especially the dollar, went up. Then we've got REITs, was down. So that's the majority of real estate. And 10-year was annualized return was 4.3%. And then we can see commodities minus this year and 0% year before. However, let's not get it twisted about commodities. If you'd got into lumber, we on Blockchain Sensei in our community was talking about lumber and did research behind it. That was a 400% return. Lithium is over a 800% return. So it's not all commodities are equal. That's the thing we've got to go over. Okay, cool. So this is the final bit now. So we are now into the property and compound interest calculator. Now, most people are buying a house, but they've never, ever done this calculation. I think it's absolutely wild that an estate agent can sell you a house without even doing this with you. I think it's atrocious. I think this should be taught in school. I think this this mortgage interest calculator should be shown in school. So we're going to do this based on London, or should we do one based on Manchester as well? Actually, I'll get the audience to type. Audience, type in chat the average price of a house. $300K, $370K. Okay. 280, 500. So we'll go in the middle. We'll go 350, right? Cool. And how many years is the average mortgage? I doubt many people are paying it in 25 years. Doubt it. I think it's 30 years plus, but 30 is my opinion. What's everyone else's opinion? Type in chat.
Yeah, let's go for 30.
30, you think? Yeah. 30 years. Okay. What this is going to do, based on the current interest rate, bearing in mind it's gone up to 5.1, I think, now. Work out how much extra you're paying for the house.
Oh, yes.
Ready?
Yeah.
And this is without fees. So, for the 350 grand house, you are paying 638 grand in total. That is an additional 288 grand that you just paid to the bank. You know, your monthly payment is £1,773. Yeah. So
Wait. Let's just iterate this. So the house costs £350,000, but the subtotal you pay is £638,000 in the 30 years. That's nearly 2x.
yeah. And if you default on this mortgage payment, remember, you don't get to keep the house.
Oh,
Keep that in mind. So remember, I'm not against property. I think property is a great investment. However, there's a strategy that we discussed with Emmanuel, which makes pretty much a lot of sense. If you're fortunate enough to have both your parents, specifically your mother, there is one person that invested for 9 months into you before you even existed, and that's your mom. So if you're lucky enough, that should be your first property business partner. Because if you don't want to go into business and do property with your parents because of whatever relationship, fair enough. but find someone else. But if you've got a good relationship with your mom or your dad,
Yeah.
you should probably get a mortgage. And then, or with all of your family, let's say, for example, it's mom, dad, son, daughter. If you split that mortgage across the 4 people, and the mortgage is £2,000 a month, that's now £500 a month. It's splitting the risk. That way, if the mortgage rates increase, it's not that bad. Whereas if you're paying this whole £1,700 a month out of your sole wage a month, it's tricky. It's very difficult. And this is why next week's episode, we're going to go over some data, which is going to show how many people in the UK are not going to be able to pay their mortgages. The stats are horrendous. The amount of people who are going to lose their homes to the banks is crazy. So this is what the working class and the middle class do. They run and they rush to get a property. That's the first thing. After they get their bit of gold, the next thing that they're doing is rushing to get onto the property market, because they've never done the maths, because school doesn't make you do this maths calculation. What it should do though, is show you this. This is the compound interest calculator, right? So we've just seen over the last 10 years, right? What was the average return of the S&P 500? 10%, right? So we're just going to go on 10%. We'll go on just investing in the S&P 500. And your initial investment to get a house, your initial down payment is 20 grand, right? Minimum. Well, 10%. So the house was 350. So it would be 3,500, 35 grand, 10% down. That's if you even can get away with that, right? So, and then you're going to do 10 years. No, we'll do 30 years, because that's how long you're doing the mortgage for. So let's see what the difference is. Doing the exact same thing you're doing with the mortgage. And remember, it was 1,000, we'll call it 1,700 a month that you're adding, like you would have done with the mortgage to pay it off. And we'll see what the end result is. That's the end result of 4.5 million instead of 600K. Well, not even 600K, a 300K house. The exact same money, but in a different financial vehicle. Total different ballgame. Then, if you've done this correctly and you've done this through a stocked investment ISA, which we can show you how to get if you drop us a message, that's up to 20 grand a year you can invest tax-free. So that would mean, if these monthly payments are correct, that this 4.5 million after the 30 years is completely tax-free. Financial literacy might drop. So if this is a bit unrealistic for people, right? Well, let's just show something. Let's just stay on this track first. I want to blow your minds first. All right. We all know that investing in Apple alone can get you 20%, right? Per year. In fact, I want you to I'll Google it right now. Average returns on Google 10 years. Oh, I said Google is meant to be Apple. We're not even talking NVIDIA. We're not even talking Tesla. We're just talking Apple. Basic. Yeah. 27%. 2018 to 2022, 35%. We're not even gonna be generous and call it 27 or 35. We're not gonna be that generous. We're just gonna say that it's the BCS standard that we believe everyone should be able to do is 20% per year. Right? Look at the difference 10% makes. Compounded over 30 years. And this is why the rich get richer and the poor get poorer. Because this exact same money that you was putting into a property is now worth 173 million if you are getting 20% per year. Is it possible to get 20% per year? In my opinion, yes. Definitely. So, if you add a bit of crypto to that mix, and you can get 50% per year, which some people do. I'm not even going to do 50. People will say that's unrealistic. Let's go 40. All right. 30 years later, now have 53 billion. But people will say that's unrealistic. So let's reduce the initial investment. Let's reduce the years to 10 years, and we'll do something realistic, right? So the average person can get £1,000. The average person can invest £500 a month, £300 a month. Yeah, for 10 years. That's it. $500,000. Yeah. But look what happens if we change that to just a little bit more. 500 here. $800K after 10 years. Cool. So this is the compound calculator, and that is the basics of financial literacy. Cool. Any questions? Sorry if we offended anyone in that session.
You don't mean to cause any offense.
It's just the facts that they're not telling you in school. Just know that what we've just taught you, you now know more than 98% of the planet. And the next lesson, if you do a next lesson with us and you book in a lesson and book in a session with us on our website, blockchainsensei.com, the next lesson will put you in the 0.1%. We provide the education, you provide the execution. And just ask yourself, out of everything we've shown you, what is the cost of not knowing more information? That's the real question. Cool. So we believe that everyone should tell a friend to tell a friend. This episode, once we've got the link for it, we're going to share it absolutely everywhere. Please, 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 please share it in WhatsApp groups, share it with friends, share it with family. It needs to be out there along with the next episode of Wealth Talk that is coming out with Emmanuel Asuko. So, is it better to rent because someone has to live somewhere? In my opinion, yes. In my opinion, what should happen is that you should be buying a home to live in with your parents or with your family, build that up, and then go and get a second mortgage, and that's the one that you live in. So one is to rent out, one is to live in. That's the way that it should be. You become the living landlord for the house that you're renting out the spare rooms. Your first, in my opinion, your first investment should never be a home. Never, ever, 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 ever. So someone's first investment be gold or a home, in my personal opinion.
In my opinion, property is a good investment for wealth preservation. Again, this is not financial advice. A lot of people disagree with me, but I don't. Okay, let me just say what I'm going to do. I am not yet a millionaire. Let's put it out there. I'm not a millionaire. Some of you might think I'm a millionaire, but I'm not. But, but I don't intend on buying property until I'm a millionaire. Until I've got at least $1 million in net worth, I believe my capital is better deployed elsewhere for capital growth. At a certain point, I believe it's good, but yeah, if you're worth less than $1 million, ask your financial advisor. I think it's better to put your money in other growth opportunities.
Well, just think of it this way: what were some of the returns that you got last year on some assets?
I mean, despite it being a bear market, I've done over 100% on some investments in crypto
There we
in
go.
less than a year since
Show
November
me
2022. Since the bear
any
market.
I'm love to see property investors that have done the traditional way and got 100% return on investment, but it's very, very rare. Now you can get 100% return on investment on buying property and flipping it and selling it, but then you got to put a lot more money in as a developer. So there's way more risk and way more work.
Can I also open your mind as well? Just on a percentage return. let me test the crowd. Let's say, right? Let's say I had 2 lots of $1 million. We'll use dollars. Which I don't, right? So I've got $2 million, and I invest $1 million in crypto, which is obviously very risky, and it does a 2x. So then it does 2 million, and then at the same time, I invest $1 million in prime real estate in Dubai, and it 2x's in 1 year. Even though both investments did a 2x, can anybody tell me the advantage of the 2x on the digital asset versus the 2x on the physical asset?
J.A. Johnson, you were fast.
Liquidity, wait. Liquidity is one of them, aka it's quicker to sell. But if I ask this question, hopefully it opens your mind. Can you sell half the house? Can you sell half the real estate? Can you sell half the flat? No. But you can sell 60% of a digital asset. You can sell 50% of a digital asset. You can sell 70%. You can sell any percent very quickly. And then you can buy it back very quickly as well in the crash. Can't do that with property.
So for me, all the stats, all the numbers would suggest, once you've done the financial literacy, for growing your wealth, you want to be investing in things that grow. Just like, you don't want to be getting in things that are doing 10% a year. Like, it just doesn't. The younger you are, the more risk you can take. If you're 60, 70 years old, maybe it's a different ballgame. If you're 50 years old, different ballgame. But yeah, but that's where you need to talk to a financial advisor, not me, because I don't know what I'm talking about. I'm just here for the entertainment. I've just shown you loads of facts and figures, but I don't know what I'm talking about. Let's get some feedback from the audience. I want to hear what people like the most, or what they took from this that they hadn't taken before, that they didn't know before. So I'd really appreciate if we get it from everybody that's on the call. I'm just going to pick people at random. So we'll go with Calm. I'm muted. What's good? What's good?
Yeah, so what I took from this session, the inflation percentages was quite alarming. Not know that I was 88%. Hello, can you guys hear me?
Yeah. You're talking about the inflation getting to 88%.
Yeah, that's crazy. So, and it's only progressive worldwide. But that's kind of a bit alarming to look at.
Well, if you think that's alarming, did you know that interest rates have been to 14.5% before?
What?
Yep.
Whoa. Whoa, man. Yeah, they're trying to make it so you can't climb up at all.
I'm going to quote something that Ray Dalio says all the time. A lot of things in history, a lot of times people are surprised by things. It's just that they haven't happened in their lifetime.
Yeah.
Look back through history, you realize, oh, hang on a minute. This has happened before, so it could happen again. But because people don't look at history and they're financially illiterate, how are they meant to know that that's even a possibility?
It's true, yeah.
They just don't know.
Because none of us thought that a whole worldwide pandemic was a possibility until it happened. So
Unless you look through history and you looked at the 1920s pandemic, then you're like, oh yeah, this happened before.
oh right, yeah.
Lucky for me, I'm obsessed with history, so I'd seen it before.
Man. Yeah,
So-
same.
So that's what it is. But yeah, great feedback. MG says, I can't unmute the breakdown of trillions, billions, and asset managers with correlate concentration of wealth in the United States. Fantastic. Thank you very much. Let's go. Andy, you've been unmuted. Andy, I'm sure a lot of this was repetition for you, but it'd be great to hear your perspective on what we covered or any angles we covered. If he's there. Nope, no Andy. Okay. Let's go Crypto Boss.
They're saying, what I got from this evening, inflation is a killer. You need to be investing. You need to have multiple sources of income. You need to be up to date with what's going on. Keep educating yourself, or you will be left behind.
100.
A house is not really an asset. In my case, my house is an asset because my house was gifted to me from my aunt.
Oh yeah,
And it's paid off.
that's straight an asset. That's definitely an asset. And you know what, as well, if you're living in again something for people of Afro-Caribbean descent, most people don't know this, but if you're Jamaican, you can actually get 10% inheritance tax instead of 40%. Just thought I'd leave that out there. If you are Jamaican, I think it's the same in Trinidad and Tobago. Inheritance tax is 10% rather than 40% that what it is in the UK. So if you are Jamaican, you might want to go and register everything that you own in Jamaica with your Jamaican passport, and then leave to your next of kin a little bit more value. So, yeah, let's go to the next person, Dubem. What you saying, broski?
Yeah, I'm good. Yeah, all good, man. That was a valuable session, man.
Yeah, man. Thank you.
And I was like best what struck to me like was obviously like the mortgage payment, like the increased mortgage payments are madness, like 1,700 a month, like in this day and age, like. And what you said is true. Like so many people just rushing to get into the property ladder, but not looking at the detailed facts. And then obviously like what Ninja said about when you did the maths, like in the space of like 30 years, you only 2x your money. Like, yeah, actually, yeah, maybe back in the days it would have make sense to get property, but like now,
you 2x your payment.
that's crazy. That's just mad.
So,
It's mad. Like,
you know what they should do? They should say this house is £350,000, but what you're actually paying is £650,000 over 30 years.
ridiculous.
But they don't say that.
Nah.
No,
This house is £1 million, but you're actually paying £1.9 million over 30 years. And if you
that's
miss
mad.
any payments, we're taking it off you.
And
Just what,
also,
one?
Even if you miss
even if
payments in
once.
the 29th year.
Even just once.
now some lenders might let you miss more than one payment, but it's very unlikely.
Wow, it's mad.
Yeah,
It's actually mad. No, it makes sense. Like, it makes sense to put getting other assets, like especially what Ninja was saying. Like, if you're not a millionaire, getting other assets that can get bigger, better returns.
you saw
Is
the
it-
difference of the same money getting 10% return, just 10% compound a year.
Wow, that's mad. It's
So,
crazy.
yep, it is. Well, thank you very much. Let's go to iPhone. You've been unmuted if you want to speak. I guess who iPhone is. No one from iPhone. Okay, we'll go Martin.
Hello. Hello, everyone.
Hello. How you doing, buddy? You're good?
Yeah, very good. How are you all?
Oh, good. Oh, good. Thank you for gracing us with your presence. What did you take from today's session? What did you enjoy the most?
So I've been learning from others about assets and
Mhm.
how to leverage your assets.
Mhm.
And from you, I'm hearing exactly the same. So it's just affirming, confirming. And the other thing is the beautiful view into the buying power of the market. So I haven't seen it in this simplicity, you know, that cross. I think I started my journey as an employee thinking I'm gonna be the honest person working till I die. Then I'm self-employed. Now I'm a business owner and I'm looking towards being an investor. That's so yeah, it's a good trajectory. And overall, it was very pleasant, very yeah, very interesting, especially how your investments can tumble. And the last thing is that if I'm to invest, probably until a certain amount of money, I'll probably be looking for something like a 10% return with someone reputable, but even there's a risk. So I've been thinking all this time, what is it where one could invest? Obviously I'm thinking, yeah, obviously Mersa is a good investment, blah blah blah. I had to slot that in there, right? But it's a very risky one. So I don't know. Yeah, I'm not going to give anyone financial advice. And yeah, so overall I'm learning. Thank you so much.
No worries, no worries. Thank you very much. Yeah, what I would say, again, I'm not a financial advisor, but in what I do is I have multiple pots of investments. So I don't have all my investments in one place, and I don't have just one type of investment. I've got my main retirement investment pot, which is the ISA pot, which me and my girlfriend put towards, and that is the magic pot that we're going to be putting money into for the next 30 years. That's the equivalent of the mortgage one. So you saw those calculations. That's what's going to happen for us. Then I've got the blockchain sensei portfolio one, which is anytime I call out something on here, I invest on that, and I dollar cost average into crypto on that one. Then I've got a separate pot, which is just literally for, it comes out of my MISC pile. So remember I showed you in that calculations, MISC. If there's a mad investment on crypto that I want to get, it's got to come out of the MISC pot. If I've bought some clothes that month, or gone on holiday that month, then I can't put that much money into my MISC pot. But I'm always making sure I'm investing every single month before treating myself to things in my miscellaneous. So yeah, that's it. So
Michael, can I just slot one thing in? Is that as a business owner, I'm investing in people, and half the time it pays off, giving the time, the attention, and so on. Half the time, it's not. So that's my investment.
Yep, 100%, 100%. That's one of the best ways you can invest in, is investing in people that you trust. But that's where, for me, I'm personally all about encouraging people to invest with family, their loved ones, their parents. Because if you're investing with your parents, you're going to inherit it anyway. If obviously if you've got the right lawyer and solicitor. So let's go to the questions in the chat. Obviously, Yusuf, don't think of anyone that's got property. Again, property isn't bad. We need to get this idea out of our head. Property is great if you're renting the rooms out. It's amazing, especially in London. What you can be renting those rooms out for now is crazy. So don't think that it's bad. It's not. It's a great income earner. You rent out the rooms, take that cash, put it into the stock market. Now you're 10 times further ahead. But if you're just getting the property and just living in it for the 30 years, that's now the problem. So yeah. So well done on getting on the property market. And yeah, if you've almost got it paid off, you're laughing, bro. Especially in London. Crazily laughing. So last but not least, Mr. J. Johnson.
Great stuff. Yeah, that was very, very valuable. not just for me, I'm sure for everyone else. I think the importance of basics and fundamentals can never be overstated, just because typically whenever a complex situation ends up negatively, it's usually because of a lack of understanding when it comes to the basic fundamentals of whatever endeavor one's involved in. So yeah, very, very valuable. I don't think you can ever know enough about the absolute basics, because the more you know about the basics, the easier it is to build on and discover new complex ways of actually improving your returns in this case, or just getting better at that particular endeavor. So yeah, very valuable session as always, and thank you very much. Looking forward to the next one.
Boom. Thank you very much, brother. Thank you. Dom, you're in the background. Do you want to say anything before we leave? Nope. Perfect. All right, guys. Thank you, everyone. Great episode for beginners. Again, please share. Please, please help share. See you in a bit, guys. Bye.